If you have to turn in homework, make sure you turn in your homework on the day of the final exam. That's the first thing you want to do is turn in that homework. I will not accept any late homework, so no homework accepted after the final exam, all right? So make sure if you need the points, make sure you turn in the homework first thing before you take the exam, all right? Okay, so let's get started. All right, so chapter 19. So chapter 19, we basically talked about what? Accounting for stock options and accounting for RSUs, right? Restricted stock units, and then the third thing was what? Earnings per share, right? Basic earnings per share and then diluted earnings per share. So first thing we want to talk about is stock options and RSUs. So the basic concept is you value these options and RSUs at the fair value at grant date, right? And that's going to be your total compensation. And then based on how many years it vests, then you have to allocate that total compensation over the vesting years, right? Okay, so let's go through the problem now. All right, so it says here, on January 1, 2014, we granted stock options, right? An option to purchase 3,000 shares, $5 par value common stock at $20 per share. Right, so the $20 is what? The exercise price, right? The options became exercisable on December 31, 2015 after the employee completed 2 years of service, right? So 2 years of service, that's going to be your vesting period. Okay. All right, the market value of prices of standard stock were blah, blah. But again, we want fair value, right? So the first thing you want to do is the estimated value of the options on the grant date was $8, right? So your total compensation, I'll give you in the back, I'll try to write big. So for number one, your total compensation is going to be your 3,000 options times your $8, right? So that gives you 24,000. So that's total compensation, all right? Then you divide that by 2 years to get 12,000 per year. Okay. So then in 2014 and in 2015, you would have what? Compensation expense, credit APIC, stock options, 12,000. Right, and so you can do your big T account here, APIC, stock options for 2014, 2015, 12, so that, and then you have 24,000, right? Okay? All right. So if you know these steps, you can already just go ahead and answer these questions, right? So here it's asking total compensation. This is total compensation here, the 24,000. Right?
Thank you.
And then it says here for 2014, what should they recognize as compensation expense? So 2014 and 2015, you would have compensation expense of 12,000 each, right? So that's your 12,000 here. Okay. And then the next question then asks, what is the journal entry on January 10, 2016, when the options were exercised. All right, so when they exercised the option, okay, so the one thing about stock options is what? When they exercise the option, they have to pay cash, right? So then you have to receive cash, so they're going to debit cash, and you have how many options? 3,000, and the exercise price was $20. So that's going to be what? 60, all right? Remember now, you're going to exercise these stock options, so this is going to go away, right? So you're going to have to debit this here to make that go away. So you're going to debit APIC stock options for 24,000, and then when they exercise the option, what are you then giving? Stock, right? So now you're going to have to record the common stock, and this is 3,000. And what is the par value of the stock? $5, right? $5, so that gives you 15,000. And then you just credit APIC common stock for the balance, which is what? 69,000. Okay, so then what's the correct answer? Huh? A. Okay. Right. I promise you, some of you will probably pick A and B. Because again, be careful, right? It's not a credit. Yeah. Hey guys, these are all open. Remember, it's not a credit to APIC, it's a debit, right? So again, be careful when you're reading the problem, right? Okay. All right. So there's room up here, guys. If you have a hard time seeing, you guys have a hard time seeing the board? Yeah? You have to come down. Come on down. Price is right. It's free. Up, play. Oh, okay. Chelsea's really sick. Yeah. You don't want to sit by her because she's contagious. You should actually sit over here. I just I'm just joking. All right. Okay. All right. Okay. You guys can't see the bottom? Is that why? It's just hard to do. Okay, questions? Any questions? Okay. So again, be very careful. Work steady, but be very careful when you're picking your answers, because I guarantee you, I will see people pick C. I mean D. Huh? All right. Okay. Not a credit, it's a debit. All right. Okay. So you notice here we have cash because when they exercise the options, they have to pay the exercise price, right? In the next example, we have RSUs, okay? All right, so here it says on January 1, 2016, Cobbler Corporation awarded restricted stock units, so RSUs, 30 million is $1 par common stock, okay? Subject to forfeiture if employment is terminated within 3 years. Okay, so they have to work for 3 years before they can get these stocks, right? So this is the vesting period. 3 years is the vesting period. Okay? All right. After the recipients satisfy the vesting requirement, right, so they have to stay for 3 years, the company will distribute the shares. On the grant date, had a market price of $3 per share, right? So again, same calculation as in the stock option. So your total compensation will be the 30 million shares times the fair value of $3, right? Gives you 90 million. But now the vesting period is what? 3 years. So then you would have to have 30 million of compensation expense for the next 3 years, right? So then you would have compensation expense for 2016, 2017, 2018, right? So then you debit compensation expense, credit, now this is APIC. Instead of stock options, it is now what? RSU, right? So 30 million. Okay. Okay, so then you make a G account here. So now it's APIC RSU 2016, 2017, 2018. So 30 million, 30 million, 30 million. So this is 90 million. Okay. All right. So here, so again, there's a variety of questions I could ask you, right? So in this case here, I didn't ask for what? Total compensation, but again, I can, right? So total compensation would be the 90 million. But in this case, all I asked for was what? What was compensation expense for 2016, right? So compensation expense for 2016 is 30 million, okay? And then it says here, the journal entry to record the lifting of restrictions on the RSU and issuing shares as December 31, 2018 would include the following. All right, so in this case here, the employees get the stock as long as they work for the 3 years, right? So they actually don't even have to pay cash for that. They just work for the 3 years, then they get the stock. So then, in 2018, you would so then you're issuing this, so this has to go away, right? It becomes 0. So you would debit APIC RSU 90 million. And then you're now issuing the stock, so you have to debit credit common stock for the 30 million times the $1 gives you what? 30 million. And then credit APIC common stock for 60 million. Okay? So then your answer then would be what? Huh?
D.
D, right? Okay, so D, debit APIC RSU 90 million, credits common stock for So any questions? So that's stock options, RSU, all right? Okay. We're moving on to earnings per share, okay? Okay, so remember you have basic EPS is equal to what? Net income minus preferred stock div divided by weighted average common stock outstanding. Okay, that's your basic EPS, all right? Okay. So basic EPS does not take into account let me put that a little different. Okay. All right. Okay, so that's basic EPS. If you have a complex capital structure, if you have these four things, right? You have convertible bonds, convertible preferred stock, stock options, and contingent shares. Okay? All right. So if you have a complex capital structure, you have to report basic EPS and diluted EPS, okay? So your diluted EPS would include these four items. If you have any of these four items, it would include convertible bonds, convertible preferred stock, stock options, and contingent shares, right? Your basic EPS would not include any of this stuff, unless they got converted into common stock. Yeah.
Would it be okay if I move down the screen?
Oh, sure. Is that better? Didn't help. No, see, this sucker is bolted.
It's okay.
Yeah. There we go. Is that better? All right.
Oh no.
All right, okay. All right, where was I? Oh, yeah, okay. All right, so that's the difference here. So then, you know how to calculate basic EPS. So then, I need space here. Okay. All right. Okay, so let's. So here you have the diluted is equal to net income minus your preferred stock bid divided by your weighted average common stock outstanding, right? So that's your basic. And then you have to add, if you have stock options, 0 to the numerator plus incremental shares. Only if what? Exercise price is less than average market price, right? You have convertible bonds. So this would be plus interest expense net of tax plus incremental shares. Convertible preferred stock. You have to add back your preferred stock div only if you subtracted it from here, right? You add your incremental shares. And then if you have contingent shares, nothing up on the numerator, and then you add here the contingent shares, okay? All right, so that's your one big fraction. All right. All right, so here, it says here, Blue Corporation had 100,000 shares of common stock. Actually, they have 100,000 shares of common stock, 10,000 shares of 8%, $100 preferred, convertible preferred stock. Okay. Net income was 500,000. Dividends were paid, right? To both the common stock and preferred stock. Okay. Each preferred stock is convertible into 5 shares per common. Okay. All right. So in this case here, so I'm going to use. So your basic EPS. Okay, first thing you want to do is calculate weighted average common stock outstanding, right? So you notice what I had up here, the 4 things. You had stock options, convertible bonds, convertible preferred stock, and contingent shares, right? Those are only included in a diluted EPS calculation, right? So then, first thing you want to do is calculate weighted average common stock outstanding, but there's no, what is that? There's no transactions, so weighted average common stock outstanding is just 100,000, right? So your basic EPS then is just equal to your 500,000. Okay, so now, whenever you're doing your EPS, right, whenever you see preferred stock, there's 2 things you want to look for, right? Is the preferred stock cumulative or non-cumulative? And then also, is the preferred stock convertible or not convertible? Okay? If it's cumulative, we have to subtract the preferred stock dividend even though the dividends were not declared, right? If it's non-cumulative, you only subtract if the dividends were declared or paid, right? Okay. Now, so that's whether or not you should subtract the preferred stock dividend, right? Now, if the preferred stock is non-convertible, is it convertible preferred stock? No, so this doesn't apply, right? Because it's non-convertible. Okay, so this would not apply, because this would only apply if it's convertible, right? Convertible, okay? So again, you want to look at, is it cumulative versus non-cumulative, convertible versus non-convertible, right? So here, they didn't say whether it was cumulative or non-cumulative, but they did say they paid dividends, right? So because they paid dividends for both the preferred and common stock, you have to subtract that. And here it's convertible preferred stock, so you know when you calculate diluted EPS, you have to include it in here. All right? Okay. So then the preferred stock div is going to be what? The 8% times the 100, the 10 million times 100, right? Okay. So this divided by 100 times, right? So this gives us, what is this? This comes out to what? 80,000, right? So then we get what? 420,000 divided by 100 gives you $4.20, right? So that's your basic EPS, right? So here, $4.20, okay? So we have this now. So now we want to dilute it, right? So we have this 500,000 minus 80,000 divided by 100,000. Correct? Yeah? Do we have, is the preferred stock convertible? Yes. Did we subtract preferred stock dividend? Yes. So now we have to what? Add it back in. And it says here what? That each preferred stock is convertible into what? 5 shares. So how many preferred stock do we have? We have 10,000 preferred stock, right? Each one is convertible into 5, so we have what? 50,000, right? So then, if we add across, what do we have here? 500 minus 80 plus the 80 gives us what? 500, right? The 100 plus the 50 gives us what? 150. So that gives us what? 3.33, right? Okay. So it's going down, it's dilutive. Okay, so that's our dilutive earnings. Right? Okay. All right, questions? So really, the fraction, all you have to know is these two. Actually, all you need to know is this one humongous fraction, right? Because you know this is basic, and then the rest of this is all diluted, right? Okay? All right, question? Yes?
Do you mind to repeat the non-cumulative versus cumulative?
Okay, all right. So again, whenever you have preferred stock, there's 2 things you want to look at. Is it cumulative or non-cumulative? If it's cumulative, you have to subtract the preferred stock dividend. Doesn't matter whether they paid or declared the dividend, all right? If it is non-cumulative, then you only subtract if the dividend was declared or it was paid, all right? Convertible versus non-convertible. If it's non-convertible, it's not in here, right? Because this is only for convertible preferred stock, right? Okay. So if it's convertible, then it goes in here, right? So again, 2 things you want to be looking for, right? Cumulative, non-cumulative, convertible, non-convertible, all right? Okay. All right, yes. Oh, sorry, I'm sorry, I put it in the wrong area. Sorry, guys. Thank you.